Something is changing. The giants are quiet, but the data is screaming. For years, big tech was the safe haven, the ultimate gold mine. But as we enter March 2026, the whales, the institutional giants who control the tide of the market, are making a move that most retail investors are completely missing. They aren't just selling, they are exiting. Look at the flow. While the headlines talk about AI hype, the smart money is quietly rotating. Why? Because the tech overcrowding has reached a breaking point. The valuation of companies like NVDA and Apple has hit a ceiling where the risk now outweighs the reward. But here's the secret. This isn't a market crash, it's a migration. If you are still holding 100% tech, you are playing a dangerous game. You are waiting for a rally that the whales have already abandoned. They know something you don't. They've seen the interest rate shifts, the liquidity crunch, and the slowing growth margins. The question isn't, is tech dying? The question is, where is the smart money moving next? If you follow the noise, you lose. If you follow the whales, you win. Right now, billions of dollars are flowing out of Silicon Valley and into a sector that has been ignored for too long. A sector that is essential, tangible, and currently undervalued. Before we reveal the destination, look at this chart. The rotation we are witnessing is not a temporary glitch. It is a fundamental realignment of global capital. While the retail crowd is still distracted by the falling prices of overvalued consumer tech, trying to catch a falling knife, the institutional whales have already shifted their focus to the physical backbone of the 2026 economy, the energy sector. Why is this happening now? The reason is simple, but overlooked. Artificial intelligence does not run on code alone. It runs on massive, unrelenting amounts of physical power. Every single high-end chip produced by NVIDIA requires a data center that consumes as much electricity as a small city. We are hitting a wall where the current power grid cannot support the AI expansion. The whales understand that the real profit is no longer in the company making the chip. The real profit is in the companies that provide the uranium, the natural gas, and the advanced grid infrastructure required to keep those chips running. This is the beginning of the great energy supercycle. However, there is one critical outlier in this tech exodus. One company that the smart money is refusing to abandon, Palantir, PLTR. The data shows a massive divergence here. While general software stocks are being dumped, Palantir is being accumulated. Why? Because Palantir is not a typical tech company. It has become the foundational operating system for the modern industrial and military machine. It is the bridge between digital intelligence and the physical world of energy and defense. Look at the flow of capital on your screen. The traditional speculative tech sector is losing its institutional support. Meanwhile, energy and defense-linked AI are entering a massive accumulation zone. This is where the fortresses are being built for the next decade. If you are waiting for the old tech leaders to regain their 2021 glory, you are looking in the rearview mirror while driving toward a cliff. The road ahead is paved with tangible assets, critical infrastructure, and companies that solve real-world bottlenecks. The migration is already halfway through. The window to position yourself alongside the giants is closing fast. You can choose to stay with the crowd and watch your portfolio's purchasing power erode, or you can pivot where the money is actually flowing. The market does not wait for the hesitant, it only rewards the positioned. This is Capital Catalyst. We provide the data, you make the move,